Okay, so welcome to the Selling Your Franchise module. Now, selling a business is also known as exiting. So you may hear the term someone exited their business or had a successful exit. That essentially means that they sold the business. So let's dive into selling your franchise. So it's most entrepreneurs' dreams to have a big exit from their business one day. And so how does it work? How do you do it? And what do you need to know? First, let's talk about why people sell. And this actually really relates to the one of the previous modules on scaling through acquisition, which is, okay, when you're looking at buying resales or neighboring franchisees, why would people sell? And so it could be the business is struggling and they're losing money. Could be that they're just bored and they want to move on to the next thing. You have life events, divorce, moving, health issues, retirement. Maybe they just want to cash out. Maybe they just want to lock in their gains. The business has been on an upward trend and they figure it's a good time to get out. And then maybe someone approached them and or someone approaches you and you get offered a price that you can't refuse. Another one is to sell at the peak. You see this with some home services concepts that are more upgrade driven, where some of the businesses during COVID just skyrocketed in terms of sales because of all the people that were home and the stimulus money and all these different things. And so you saw a lot of people that have been in their business for 10 years see their businesses grow substantially in a few years, and then they go, okay, hey, this is the perfect time to sell. Let's get out now. And then any other reason you can imagine. So there are a few things that you need to know about when you're going to sell. So one is multiples, keeping your books clean, maximizing profitability, and taxes. So multiples, let's talk about multiples. So multiples is how much your business will sell for as a multiple of profit. So the average small business will sell between a 2 to 4 times multiple. What does that mean exactly? If your business is making $100,000 a year in profit, it would sell between $200,000 and $400,000, and that's a 2 to 4 times multiple range. Now, that may not sound like a lot, especially if you've owned your business for a long time. So how do you maximize the most amount of money possible in selling your business? Now, the first thing that I want to bring to your attention is that, okay, in this example, actually, let's say you're making $100,000 a year in your job, and you're putting money in your retirement account. When you go to leave your job, you can't sell it back to your employer. You can't go, hey, I'm leaving, I'm retiring, and now I'd like my payout of $300,000 for the value I've provided for the company over the last 10 years. They would laugh at you, right? So even if you just compared apples to apples of working a job, making $100K a year, owning a business making $100K a year, well, at the end of your business, you can sell it, right? So that's already a leg up right there. So how do you maximize the most amount of money possible in selling your business? Well, the first thing is that you can sell for a higher multiple. I had a friend who recently sold his business for a 6x multiple to a private equity company. And although it was not a franchise, it was in the home services space. And this is something to point out right now. Private equity companies love franchise businesses. They love to buy franchisors, and they also like to buy successful multiple unit franchisee locations just because of the systems and that it's a proven business model. Another friend of mine recently had his business valued at a 9x valuation. And hold on, I thought you said the average was 2 to 4 times. Correct, that's the average, but let's break it down. First, if you're trying to sell the business and you aren't making money, selling for a multiple really goes out the roof. And what you can sell for is really based on the tangible and intangible assets of the business and what someone is willing to buy it for. So the first thing is to make sure your business is profitable in the first place. So as an example, when I bought our resale, when we bought it, the business was break even. It wasn't really making any money, and so we just had to figure out what we thought the value of the business was based on the assets, the sales that it was doing, etc. But at that point, it's tough, and sometimes sellers can be completely unrealistic in terms of the number that they want. One of the biggest drivers of a multiple is how dependent the business is on you as the owner and what your role is. The more the business depends on you to run and operate the day-to-day of the business, the lower the multiple it will sell for. If you run all of the business, sales, marketing, operations, then the business can't really run without you. So you'd be looking closer to a 2x valuation or less. Now, the more people you have that are autonomous, meaning that they can make decisions and operate functions in the business without your day-to-day input, that will increase the multiple that you can sell for. So my friend who sold for a 6x multiple is not involved at all in the day-to-day running of his business. His business was making about $1.5 million a year in profit, and he had a general manager and 40 other employees in the business. If he was involved in running the day-to-day and didn't have a GM, the business would have likely sold for a lower multiple. Now, something that did impact his business were looser relationships that helped generate sales in the business. The more sales and revenue are tied to key relationships, and it puts the business in a vulnerable position, thereby lowering the valuation. The more diversified your revenue from various customers and sources that aren't based on you being friends with your biggest account, that will help the business sell for more. As an example, if 70% of your business revenue is derived from one specific customer, well, that would automatically lower the value of the business, because if that customer decides to leave or not do business with you, then 70% of the revenue is gone. Now, in the example of my friend whose business has a 9x valuation, he has a GM, he has a sales manager, he has a sales team, he has a team who provides the fulfillment, and his sales come from customer referrals and buying leads, so it's duplicatable. He works less than 20 hours a week in the business. He also has a higher profit margin. He targets about above a 22% margin, whereas my friend who sold for a 6x multiple was operating at a 15% margin. So generally speaking, the higher percentage your profit margin is, the more it will impact your multiple, and typically will increase your multiple, assuming that the profit margin's not just high because you're one man banding the business, meaning it's just the business is pretty much just relying on you. So if you want to one day sell your business for $1 million, then at a 4x multiple, you need to be making about $250,000 a year in profit and also have a strong team in place to command a 4x multiple. If you don't and you sell closer to 2x multiple, then you need to be making about $500,000 a year in profits. When you start with the end in mind, it helps to drive all of the decisions you make in your process of buying a franchise. If your goal is to maximize cash flow in the short term and you don't really care about selling the business, then you may run your business lean and keep your costs down to drive as much profit as you can into your pocket. If your goal is to build an asset that you can sell later on, you may sacrifice your short-term profit to keep reinvesting back into the business through marketing or hiring more people on your team. So this is why you will see that, like huge companies, for years, Amazon lost money. They weren't profitable. Now, you and I aren't in Amazon and aren't publicly traded on the stock market and have, millions or billions of dollars in funding to allow that. But I think I mentioned earlier in this program that I have a friend of mine that has owned over 47 Dunkin' Donuts, and in the beginning, he intentionally made less money in profit so that he could build and scale a team and not be a slave to his business. So, really there's no right or wrong way to do this, but I want to emphasize that without being clear on your goals and thinking realistically on choosing the right business that aligns with your goals, then you set yourself up for failure and a lot of mistakes. Choosing the wrong franchise can ruin all of your plans. As proven as franchising is, there are still a lot of bad franchises and people that lose a lot of money every year in their franchise business. So you need to choose wisely. Right? That's the rub in all of this, is that you have to choose the right franchise business. It's incredibly key. There is 100% a franchise out there for you that aligns with your goals, where you can make your goals happen, right? But out of the 4,000 franchises out there, you need to make sure that you are choosing the right one. So let's jump to the next module and let's talk about the last thing to do.